this video, I want to look at how different sources of income attract different tax rates for basic rate taxpayers. By mixing them maybe in different ways, you might be able to save some tax. So this video I'm concentrating on basic rate taxpayers. So the first $12,570 for most people is little or no tax to pay, and after you earn $50,270, then you pay higher rate tax. I'm going to look at that in future videos, but this video I'm going to concentrate on that slug of income between $12,570 and just over $50,000. So that's for basic rate tax that almost everybody pays in any case. So we can have lots of different sources of income. We can have interest, we can have rentals, we can have self-employed, employed, we can have dividends through limited companies. So there's lots of different sources of income and they attract different rates of tax. At the lower end, basic rate tax is at 20%, and on interest and on rentals you just pay 20% tax. So that's some of the lowest tax, although there is a wrinkle in rental that we'll come to later. If you're self-employed, you pay 20% tax, but you also pay 9% national insurance. So overall, that is 29% tax that you pay. In a limited company, it's just got more complicated because the corporation tax can vary depending on what your profits are. So you pay as dividend tax, you pay 8.75%, which that sounds lower, that's lower than 20%. Well, it is lower than 20%, but the company will have paid corporation tax before you receive that, and if it's your company you pay it, and the corporation tax rate is between 19% and 26.5%, so you'll pay something like that plus the 8.75% dividend tax. So the overall tax that you pay will be between 26.1% and about 32%, depending on rate of tax your company pays. So again, that it could be a bit lower than being self-employed, or it could be a bit higher depending on the profit levels within your company. But the interesting thing within your company is that retained profits, so that's money you keep and don't pay out to shareholders, that is only taxed at the corporation tax rate, which is lower than the self-employed rate. So if you keep the money in the company, you're probably better off with the company and pay less tax. Salaries are often seen as a very high rate of tax, and the reason is because you pay 20% tax plus 12% national insurance plus 13.8% employers' national insurance, and if you're the employer, it's your business, then you pay all of it, and that's 45.8%. Oh, what a lot of tax. But salaries can be good. If you pay, maybe you've got a spouse that works separately, say and earns £20,000 or £30,000 a year, or you've got other family members who are not high earners, and they work in the business, then you can pay them. And if you pay them up to normally $12,570, but it might be $9,100, something like that, depending on your exact circumstances, you're only going to pay basic rate tax. You don't pay national insurance, so you pay 20% tax. So paying other members of the family can be one of the lower rates of tax. And what I really want to think about here is how you can also vary it. So if you've got interest is now taxed very lightly at only 20%, much less than dividends. Well, if you put money into the company, you might want to take interest on the amount of money that you put in rather than take dividends, because that is a cheaper way of taking the money out. I've already talked about salaries. Rentals, people quite often put property rentals into companies, but it's worth thinking about whether that's what you want to do if you want to take all the money out, because actually rental income pays less tax. But on rental income, there is the big caveat, because interest, if you own it privately, is in the first instance disallowed. And the big problem with that is it's disallowed and then you're given a 20% tax relief on it. Well, at the stage it's disallowed, it can force you up into paying higher rate tax. And if you're paying higher rate tax, then it's like all bets are off. That just makes it worse. So again, it's nuanced, because you want to receive rental income, but you don't want disallowed interest to force you into higher rate tax. So there is quite a lot going on there, isn't there? And hopefully something in there that will allow you to slightly change the way you do things so that you can save some tax. Look, if you want to sit down with us and see if we can work out a little plan for you, then we're happy to do that. Or if you're not our client, you can do that with your own accountant. I would advise you to have a good think about it. I do regular updates on tax and accounting, and I'll be doing one very soon on how this affects higher rate taxpayers, how different sources of income affect higher rate taxpayers. So I'll be doing that soon, so if you subscribe you won't miss out, and if you press the like button, it helps me in the channel. So thank you for that.